members. Welcome you all for the today's very interesting program on accounting standards. The topics covered is emerging issues in revenue recognition in Ind AS and IFRS regime, emerging issues in merger accounting in mergers and acquisition. To handle this session, we have an eminent speaker, none other than CA Dharshan Varma, engagement partner EY, Hyderabad. Is our own state member from Mysore. Is handling this today's session, enlightening us on this topic. I request all the members to actively participate, and you can raise your queries, whatever queries in chat box. It will be addressed at the end of the session. And I have some important announcement made for this month. Hope you all completed your audits. Maybe another 7 days is extended. You'll be completing by now, by 7th. We have not done much program during September because of audit tight schedule. We are having so many programs in October anyway, because we cannot conduct any programs in November. On 8th, we have a joint program with ethical standard boards on ethical standard, and 10th Monday we have a very interesting program on UAE taxation, because Gulf countries are coming with corporate tax. We are having a program on UAE corporate tax. And 12th we have another interesting program, mentorship program for young members. This session is going to be handled by CA Gurunjana firm. And 15th we have a one-day seminar on transfer pricing. And 15th October we are going to start forensic accounting and fraud detection certification course. Very much needed, because very few professionals on this area of practice in Bangalore and in the state, we can say. But there is ample opportunity for forensic auditors. Very limited seats of 50 seats for this program. I request members to join for this program. On 19th we have a AQM audit quality management, and 28th and 29th we have a 2 days national conference. These are the programs covered in October. I once again welcome you all for this program. I welcome CA Dharshan sir. Welcome you, sir. Over to Shripad Bhatt to introduce our today's speaker, CA Dharshan sir.
Srinivas sir. So it is my pleasure to introduce today's speaker, CA Dharshan Verma. So Darshan Verma is partnered with financial advisory, accounting advisory services, and specializes in IFRS, US GAAP, Ind AS, process improvement, digitization of financial reporting. He works with clients in the TMT, manufacturing, FMCG, automotive, and infra sectors. So his accounting advisory services under various gaps. He has various skills, capital market offerings in IPO, SPAC, REIT, extensive knowledge of ERP and other tools, that is SAP, Oracle, Tableau. Also has extensive experience in handling multinational, multi-location clients and Indian companies. So he is also a fellow member of the ICAI and holds a bachelor's degree in commerce. It is worth noting that he was a gold medalist in BCom and also a rank holder in his second PU. So his experience are like this. Prior to joining the firm, Darshan has worked in the global IFRS audit division of Fortune 500 company in Germany for 3 years, doing SOX and IFRS audit. He has also worked with 2 Big 4 consulting firm over 11 years, providing audit services in accordance with Indian GAAP, Indian tax laws, IFRS and US GAAP, and implementation of technology solutions. He has also worked on large multinational inbound accounts in various sectors and has sound experience in various gaps and SOX requirements. In recent years, Darshan has been leading the digital finance function of EY FAS in India and has built products of EY FRH. Darshan has extensive audit and consulting experience spanning across a sector of industries including F&A services, energy sector, automobiles, IT, consumer goods, pharmaceutical and infrastructure under India GAAP, US GAAP and IFRS. Darshan has good knowledge of accounting and reporting issues and regulatory relevant to Indian and multinational companies operating in India. His experience of capital markets includes pharma client, healthcare, real estate. He has led trainings for audit and accounting matters, Indian GAAP and Ind AS for the firm and the client personnel. So with this brief introduction, I would like to once again welcome Darshan Verma for the today's session. Welcome you, sir.
Thank you, Shripad. Thank you for the introduction, and thank you, Srinivas sir, for giving me this opportunity to speak. I do realize that I'm speaking on a Saturday evening, that too especially when people must have tried to complete all their audits by 30th September. As I mentioned to Srinivas when we were trying to organize this session, I said I will try to keep this session as lively as possible, making it very relevant to the context in terms of all the emerging issues, and not taking anybody through the standard itself, because it can become extremely boring on a Saturday evening. The whole focus of the next 3-hour session will be all to do with practical implementation issues, what I have noticed and what clients have noticed. Without bringing any client into picture, I have anonymized many of those case studies. So the idea behind this presentation over the next 3 hours will be to focus on what are the emerging issues in revenue recognition and what are the emerging issues in the business combination. The reason we selected this, and it was a joint selection between B and Srinivas, was these are two big topics which can change the way the P&L and the balance sheet of a company appears. Revenue is top line, and everybody knows that this top line can swing differently if you have a different number on top line. All of you must have recently looked at many large companies' balance sheet. Because of the changes in IFRS or Ind AS 115, the numbers which they had reported in unaudited financial statements was significantly different from the audited financials. This is all because the principles of Ind AS 115 are completely different from the common parlance which all of us want to implement. So without much further ado, what I will do is I'm splitting this entire session into about 1.5 hours for 115, and I will also take another 90 odd minutes to focus on Ind AS 103. When I am talking about it, I will probably keep interchangeably using IFRS 15 as a quasi to Ind AS 115. And similarly, I will use IFRS 3 as a pseudo name for Ind AS 103, because most of them are very similar. The principles are very similar. As all of you know, even the carve-outs are fairly limited in both these sections. So let me share my screen, which will focus on 115. As I mentioned, these are all practical case studies which I'm focusing on. And do please confirm once you are able to see my screen, so that then I can walk you through. And as I mentioned, we will keep it very interactive when I walk you through this session. I am hoping that Srinivas did give me a thumbs up that he is able to see my screen.
Yes, sir. Yes, sir.
Perfect. So then I'll walk you through this 115 in terms of practical issues which I have noticed, and this is very interactive. Considering there are a lot of case studies which I have put in, I do realize that the initial intent of this session was supposed to be an in-person event in Bangalore. Unfortunately, I have not been able to travel. Otherwise, this would have been an evening event in Bangalore, where this could have been more lively in terms of session. Because there are largely most of these are practical case study based topics. What I would request all of you is to do a raise of hands in terms of what you believe is the right set of answers. Because I don't know whether we can keep opening the audience to speak up. It may be very difficult to do that thing in the Cisco WebEx. So my request is, if you can do your voting button and keep telling me, then I will give you the rationale in terms of how did we conclude a particular item has to be done in this particular fashion. Okay, so let me proceed further, and if there are questions, please feel free to put in the chat window. Because I have minimized the chat window, I may not be able to see everything which you are highlighting. So I would request Shripad to prompt me if I'm not missing out any of the chat which is coming out. Yeah. So kindly bear with me if I'm not able to see all of your chat thing here. Okay, let me proceed on this. As I mentioned, all of you know Ind AS 115 or IFRS 15. Just to put a 2-minute context, and I will not do any further context setting beyond that 2 minutes. Ind AS 115, IFRS 15, and ASC 606. ASC stands for Accounting Standard Codification. This is the US GAAP equivalent of IFRS 15. All these standards, what they have done is they have gone ahead and changed the basis in which you will do revenue recognition. In fact, the standard itself says revenue from customer contracts. That's the headline of the standard itself. So all these three standards, which are almost interrelated to each other, and it was also co-developed in the beginning of when both 606 and IFRS 15 started developing. Or only towards the end they started slightly taking a different path, but otherwise most of them are converged. What they did was they said fundamentally there are a lot of new business models which were not able to be addressed in the previous GIPs. The ASC 605 or your IAS 18 did not have adequate number of guidance available in them in terms of dealing with new business topics. Think of all the new businesses which have come into force in the last decade or so, and think of whether how did you deal with those. As an example, you now see in Bangalore, because I'm dealing with a lot of people who are in Bangalore based, you will see the amount of fintech companies which have come into place, right? You would not have thought about all these fintech companies in existence a decade back. Think of all the platform companies which have come into place, be it the Amazons of the world, the Flipkarts of the world, Swiggies of the world, and Zomato of the world, right? Previously, when all of you knew about Zomato, Zomato was not a food delivery app. It was just an app where they would recommend or give you recommendation in terms of the restaurants. Then it got converted to a food delivery app as well. So all these new age businesses have come into picture, and suddenly you start realizing, hey, how do I deal with all these companies? How do I deal with the revenue recognition with all these companies? Their business models are completely different. The valuations, right? Skyrocketing valuations, where on the one side you have skyrocketing valuation, on the other side, as a chartered accountant, if you see their balance sheet, loss-making companies, negative net worth companies, you start thinking, should I be giving going concern emphasis of matter, when the other side, the private equity is saying this is worth $10 billion. So there's so much of contradiction, right? You're saying that it is a negative net worth company, potential going concern issue, but hugely valued by all the potential investors, saying that this is a good valued company. So all these issues came into picture, and what the regulators realized is, unless the standard is able to catch up with all these newer changes and also flexible enough to deal with all the new emerging issues, you will not be able to uh, make sure that the financial statements are a true reflection of the business. The last thing you want is the accounts, books and records are not showing the true and fair picture of what the business is doing. Otherwise, you are writing an accounting rule which is not married to the business rule, and accordingly you are giving an interpretation because you are so very rigid. So that was not supposed to be the intent. So the regulators went ahead and said, let's make the entire standard slightly more enhanced so that it can capture variety of business changes which has happened. And what I'm going to deal with in the next 1.5 hours is all about different industries, practical challenges, and how we have dealt with all those practical challenges, or how the companies have dealt with all those practical challenges. So let me pick few examples, and it makes it easier for all of you to see how this is being dealt with. So let's take one example, and this is relevant in all our contexts, because all of us post-COVID have started going back to, it's called the revenge uh, uh, I'm forgetting the term now. So all of us have started doing the revenge vacation. People could not do any vacationing in the last 2 years. So thanks, Karthik. So revenge tourism is the right word. So all of us have started now going across all the cities, because 2 years we were under lockdown. Now let's take the example here, and let's look at what should be our conclusion. In this example, if you notice from left to right, airline industry, and not necessarily limited to airline, even for railways, if entities are making payments to passengers for delays, cancellation, denied boarding as per legislation. Okay, this is now a legislative activity. Now the question arose, and this was picked up by the IFRIC committee, question was, how do we deal with all these payments which are being made by all these companies to their customers, right? You have collected the money. Now you have to give the money back because you are either there are delays, cancellations, or denied board. So when this question arose, there were two potential interpretation issues. Should I do this as an adjustment to consideration payable to customers, because of which I should reduce revenue, or should I be showing this as an operating expenses? Some people may argue, Darshan, does it make a real difference? Because end of the day, from a net profit point of view, both are same, right? Whether you show it as a reduction of revenue or you show it as an expenditure, net profit remains the same. But as all of you will imagine that while the profit remains the same, from a disclosure, recognition, measurement point of view, it's an important thing saying that whether it should fall within the standard of Ind AS 115 or IFRS 15, or it should go to some other standard, because of which all your ratios will get impacted. So that is the reason why the agenda decision between the IFRIC committee was, they looked at it, they said, hey, this is not an operating expenditure. I cannot consider this to be an adjustment in terms of operating expenses. This is not an assurance type warranty. I have to the practitioners have to consider this as an adjustment to the variable consideration, and accordingly, variable consideration includes penalties, and this is in the nature of variable consideration and adjustment to the revenue. So accordingly, if you have any of your clients or you yourself are working in any of these industries which will have any of these kind of payments, your requirement will be that you will go back and adjust your top line and not show them as an adjustment to operating expenses / any of assurance type warranty. So this is an adjustment to variable consideration. Accordingly, it's an adjustment to your revenue. So it's an important thing because a lot of us believe that, okay, there's anyway, all these are payments which cannot be ascertained, and accordingly, whenever the payment will happen, we will go back and do that. So there is, so IFRIC was very clear. You can't go back and show this as an operating expenditure. This is well within the standard of IFRS 15, and it has to be adjusted against your top line. Moving forward, and this is an interesting conversation, right at the time the entire implementation happened on IFRS 15 or Ind AS 115, this became a big topic for discussion, especially because the concept under the previous standard, AS 9/IAS 18, was transfer of risk and rewards, and the concept of control was never in play, right? So to jog everybody's memory, there is a 5-step model in IFRS 15 or Ind AS 115, and that 5-step model focuses on transfer of control. It's not transfer of risk and rewards, it's transfer of control. Now, if you notice a shipping term, and all of us are very familiar with shipping terms, let me take the example and probably explain this in a better way. So if I take this example, if you notice the example, so this is CIF, and I'm assuming all of you understand CIF. If I take this example of this background, it says company A, a mining company in South Africa, Mines Iron Ore, has entered into a contract with company B, which is a Singapore company, a manufacturing company in Singapore. A has agreed in their contract with company B to ship the products using CIF Incoterms. Okay. Now, in their contract, company B does not have the right to pledge or sell these goods until the port of destination, which is Singapore. Company will have the right of payment at the port of loading, which is 30% of the invoice, which is the advance money. Furthermore, company B can only collect the goods from the port of destination specified by company A. So question arises, when is the control of goods transferred to company B? Is it at the port of loading as per CIF Incoterm or at the port of destination? Now I will let all of you absorb this for 10 seconds, 10 to 15 seconds, and then I'm hoping that some of you are able to give out your answer before I go to the subsequent slide giving you the answer. So Shripad, please prompt me if people are able to respond to this. Sorry, before that, do I know how many people have logged in? I saw about 20-25 participants when I started the session. I'm hoping that the count has now increased. Shripad, you are around? Okay, I can't hear Shripad.
Sir.
Yeah. Yeah, Srinivas.
ಹೇಳಿ ಸರ್ ಏನೋ ಮಾತಾಡ್ತಾನೆ.
No, I was asking Srinivas, I was asking if people are able to give out answers on the window because I am asking, this is all case study based session subsequently. I'm assuming that people are able to respond.
Yes,
Okay,
question and
Yashaswini is-
answers only I think they are responding ಅಂತ ಅನ್ಸುತ್ತೆ.
Okay, okay.
Q&A ಅಲ್ಲಿ ಆನ್ಸರ್ ಇದು ರೆಸ್ಪಾಂಡ್ ಮಾಡ್ತಾ ಇದ್ದಾರೆ.
Okay, okay, done. So I think I saw Yashaswini saying port of destination, right? Okay, let me go forward so that I'll give you the answer. It becomes easy.
Okay.
CIF stands for cost insurance paid in terms of shipping, determining the shipping in the contract. So this is determination of shipping terms in the contract. So very important because the shipping terms decision tree becomes an important element of conversation here. So question arises, as you remember, I mentioned that in the context of IFRS 15, it is transfer of control and not necessarily transfer of risk and rewards. Very nuanced conversation, I'll not get into it, but it's more in terms of transfer of control of the goods which has to happen. So in this case, if you notice here, even though company has the right to payment of 30% at the port of loading, company B does not have the right to sell the goods while on water, okay, and only can collect the goods at the company A specified port. Company B does not have physical possession. Significant risk and rewards have not passed on until the port of destination, as this point where they can direct the use of obtain. Company A will stand to lose if insurance is paid out for an amount less than the price, and accordingly it is at the port of destination that the control is. So if the control passes at the port of destination, shipping services are not considered to be separately identifiable because they are necessary for company A to fulfill its obligation. But if the control passes at the port of loading, which is this place, shipping services are likely to be a separate performance obligation, and the transaction price would need to be allocated between two performance obligations. One is shipping services, one is the sale of goods. Company would need to consider if it is an agent or a principal in relation to the shipping services. Very important because agent versus principal is also another big debate under 115. I'll pick up one example and highlight that to you. So in this, you will notice in this case, it is the answer is not merely driven by whether it is CIF or where the control is transferred. If you are able to determine that you are able to unbundle the contract, then you can do the accounting at the port of loading. So then your shipping services may have to be accounted either net or gross basis a determination of agency versus principal. If we are able to establish that the control passes at the port of destination, which is B, then your shipping services are not considered to be a separate performance obligation, and accordingly you can go ahead and account for the entire contract value at the port of destination. So it's a very nuanced answer based on the contract review. You may get to both answers based on further reading of what is written in the contract and not limited by the shipping terms alone. Very important because when you're doing this cutoff in many companies, there's a big issue in terms of when to recognize revenue. A lot of people assume that they can go ahead and recognize revenue merely by shipping terms which are highlighted in the entire invoice. But it may so happen that the invoice may have a shipping term, but the entire MSA, SOW, main purchase order, may have a different contract term. So a combination of your contract terms, which is there in your invoice, and also what is really written in your main contract have to be read together to get to an answer. Otherwise, you may get to a wrong answer, because of which, it may so happen that your auditor may come back and ask for a revenue reversal. So you don't want to get into that scenario that at the end you have accounted for both revenue and profitability on certain last minute deliveries, and at the end during the audit it is identified that you have different performance obligation and also different control terms, because of which the revenue gets deferred. So very important for you to go through before you conclude where does the actual control get transferred and whether you have to bundle or unbundle the contract. So let me go further. Let's take another example. If you take this, so that was an example in the context of the sale of goods. The previous context was in the context of when we said the mining industry. Now let's take the aircraft industry, and this is also again in terms of how customized goods are developed. So if I take this example, it says Company A manufacturer of specialized military aircraft for Company B. Design and construction of each aircraft built by Company A differs substantially. So let me just lift this so that on the basis of company B needs and the type of technology that is incorporated into the aircraft. Does company A performance create asset with alternate use? How will revenue be recognized? Okay, I see Karthik responding as no. So his response as no is in the context of company A creating a separate asset, because I'm assuming that he believes that there are no separate alternate use. So he's believing that we don't need to create a separate asset because I am creating IP in the context of specialized military aircraft which I am producing. Am I getting any other answer? Any other person who's able to respond? Okay, I'll assume that as a no. I will move forward and give you the answers. The solution says company A will need to incur significant cost to rework the design and function of aircraft to make it suitable for other customer. Just so that you take the context, let's say company A is ABC company, is manufacturing an F-16, is manufacturing a Boeing. Okay, oh sorry, military. So there's an F-16 and there is a military aircraft of French. So in both these cases, each of the technology is different. So each of them will not be fungible that way between two aircrafts. So the important thing here is from a company A who's like a job worker, who's manufacturing these aircraft, will have to rework the entire design and function of the aircraft to make it suitable for another customer. I cannot just take the technology of the aircraft of company B and start applying to, let's say, a company C, because of which I will have to do a significant change in my tooling cost, and also the significant change in the fact that none of the manufacturing process may be same. Because of this, the conclusion is company A, because it is so customer specific, it is not made to stock, but it is made to order. So customer specific requirement limit company A's practical ability to readily direct the aircraft to other customer. Thus, the aircraft has no alternate use for company A. Additionally, there may be contractual restrictions to transfer the aircraft to another party, because company B will not let its IP be transferred by company A to third party. This is like there are a lot of these challenges with manufacturers in the phone industry, where they end up copying what is available. Let's say with an iPhone, you will almost appear that an iPhone, there is a replica copy of an iPhone with another manufacturer. It almost looks very same, but without the real features of iPhone. So the idea is, if you have all those restriction and exclusivity contract, you will not be able to transfer that, because of which the conclusion is company has an enforceable right to payment for performance completed till date. The revenue is recognized over time. That means as and when I complete the production, not necessarily full production, as in when I finish to the extent I have been asked to do by company B, I will do a progressive revenue recognition and I start recognizing revenue. So important thing here is, first question was, can I create an asset? Answer is no. How will revenue be recognized? Revenue will be recognized as and when I start completing the performance. So that's the structure in terms of doing accounting for made to order. The reason I took this example is there are a lot of made to order companies. If you are making any goods which are specialized, okay, first question is, hey, can I start creating my own asset? Because now I have a specialized basis of manufacturing. I know the entire basis. So do I, whatever money I incur to create those, can I start creating an asset? Answer is no, because you may have a contractual restriction by your customer who say that you are only a job worker or a toller or a bottler, where you are doing this on the behalf of another company. So you cannot create an asset of your own. You are actually utilizing the IP of the main entity. Accordingly, you cannot have your own asset. More importantly, because you will also not be you will also not have the ability to transfer those IP to another customer because of the exclusivity agreement. You cannot do a separate asset accounting in your books. Second thing is, because you are working on behalf of another customer, you are treated like a contractor and you will do progressive accounting, a percentage completion accounting in terms of your revenue recognition. As in when you incur cost, you'll also do revenue recognition and you will do a POC method of revenue recognition. As and when the progress happens, you will start recognizing revenue. So I'll progress further on this. So let's take another example. Kindly read this. I will give you guys a minute to read this and come back. And then we will start responding to this. Company A enters into a contract with a customer to build 15 vessels over a 3-year period, both design and production services. Okay, this is here. In this case, even the design services is my requirement, right? Customer is not defining those design. I am doing this. Has not built a vessel of this type in the past, expects that the first vessels may take longer to produce than the last vessels, right? Because there will be a lot of back and forth and an iterative process of building those first type of vessels. Subsequently, once the production is stabilized, once the design is stabilized, you can start producing a lot more. Company A concludes that the design and production services are a single performance obligation. Company also concludes that the vessel has no alternate use and the entity has an enforceable right to payment for performance complete to date. Consequently, the performance obligation is satisfied over time in accordance with Ind AS 115 para 35C. Which method to measure of progress would faithfully depict the entity's performance over time? Any thoughts, any views? I'm not getting any responses. Okay, so let me put out the response based on each stage of completion. Okay, because let's go to the answer. Yashaswini mentioned that it is based on each stage of completion. Since the design and production of the vessels are considered as one performance obligation. Okay, so Yashaswini, in your example, you're believing that there are multiple performance obligations. If you notice here, company has concluded both design and production services as single performance obligation. They must have gone through a detailed evaluation process to get to this. Some people may end up challenging, but in this case, the company has gone through the 5-step model and concluded that the design and production are a single performance obligation and not two separate performance obligations. Because as considered as one performance obligation, a unit of delivery method would not accurately capture the level of performance. What does this mean? That for because I'm building 15 vessels, the answer here is because I'm taking this as one performance obligation, unit of delivery is every vessel being delivered is not to be considered as a basis for revenue recognition. An output method will not reflect entity's effort in designing the vessel. So neither output based nor unit based will be the right basis for doing revenue recognition. So in this case, the answer is instead an input method is more appropriate. Such method based on cost incurred. Okay. So a POC where input cost divided by total cost to be incurred into the revenue contract value will be the basis on which you will be able to do the revenue recognition. Because there are multiple fact patterns here. The fact pattern is you as a company are doing design. You have the full control over design. You will do the production because it's first of one of its kind. You may incur more cost in the beginning. The first vessel may incur more cost than the 15th vessel. And accordingly, the question is, should I do vessel by vessel accounting of doing this entire performance obligation? Or even better than that is, can I split the entire design separately and the production separately? All these are various fact patterns. But if you notice, the important conclusion here was company A concluded that this design and production, nobody else may want to take that. As an example, if I am building building this particular vessel, let's say I'm building a tugboat, and that tugboat design is so unique to let's say only one particular shipping company, and that same vessel will not be utilized by other shipping company. So then this particular company A decides saying that this tugboat design is not relevant for many other shipping companies. So this is only used for this company. So I can't have any alternate use. So I will not create a designs a separate performance obligation. Customer is interested in getting these 15 vessels. So neither an output based nor a unit based accounting will help. So as and when I incur those costs, I should take that into my numerator. My denominator will be the total cost for the total 15 vessels multiplied by the total contract value will give you the total revenue to be recognized over a period of time. That's the basis on which they have gone ahead and concluded. Okay, let's take another one. In terms of one of the IFRIC agenda which got discussed, entity-wise constructing building for customers. Okay, I'm not going down the path of real estate here, so please keep in mind so that it becomes very important for all of you. The control of building is transferred over time. Again, as I said, there is RERA Act. There is a lot of interpretation issues. This is not revenue recognition for the real estate sector like the way we are doing. This is more like a construction contract. So kindly look at the fact patterns carefully so that it becomes easier for you to interpret and give me an answer. Entity-wise constructing building for customer Z. Control of the building is transferred over time. Progress of performance obligation was measured using an output method. Entity incurs cost of 100 in the foundation bill of quantity. Subsequently, the entity will incur cost for walls, columns, doors, and windows. Margins on each of these activities is very different. At the reporting date, the cost incurred related to construction work performed on the goods that is being transferred to the customer as the goods is being constructed. How to recognize cost incurred to fulfill a contract as an entity satisfies performance obligation in the contract over time. Any thoughts? I have a very silent audience. I just have to now see if the audience is responding. I as a speaker, especially in these kind of sessions, if I don't get a response, then I'm not sure whether I am able to connect with all the audience better. Okay, let's assume that all of you have got the question. So let's try looking at the response and discuss the response. The cost of construction incurred by entity Y relates to, okay, let me just pull this here. Relates to partially satisfied performance obligation in the contract that they are relating to cost in the performance. These costs do not therefore generate or enhance resources of the entity that will satisfy the performance obligation in future. These costs do not meet the criteria for separate capitalization. So I'm not capitalizing these costs to fulfill a contract. Ind AS requires an entity to recognize as expenses when the cost incurred that relate to satisfied performance obligation or even partially satisfied performance obligation, because of which this entire 100 rupees which I have incurred, okay, will be accounted as an expenditure and not as a cost to fulfill a contract. As all of you, again, jogging all of your memory, IFRS 15 also has a concept of cost to fulfill a contract. There are various examples around that. So this particular example does not fit into a cost to fulfill a contract. Accordingly, this will not fit into the deferred cost. It has to be expensed off. It is a period cost accounted for in the books. Okay, this is an interesting thing which may resonate with all the participants from Bangalore. I want you to read this. I will read it out for your benefit, but I want you to also come back and at least I would expect a response on this. Entity A enters into a contract with a customer, which is entity B, that is within the scope of 115. The contract is for supply of outsourced services, BPO outsourcing, call center outsourcing, right? Very common, very common thing for the Bangalore audience. A lot of BPO companies, KPO companies. So this example is A is entering into a contract with B for supplying outsourced services. What is that we are doing? To be able to provide the services to B, entity A incurs training cost. Okay, I train my employees to speak in English. I train my employees to speak in Spanish. Okay, because I may have customers who are calling me from different locations. So I say I have to give German classes, I have to give Spanish classes, I have to give English classes as well, so that they can use the proper language and also use the proper dictum, so that the other audience is able to clearly understand what we are speaking. Now, because we are incurring a training cost on a customer contract, what does it say? Entity A does not identify the training as a performance obligation because it is important to you have this, without which I will not be able to deliver. The contract permits entity A to recharge to entity B the cost of training for entities A employees at the beginning of the contract. Okay, this I'm assuming is a new contract with entity B, or it's a contract where it is being shifted from another company to entity A. So for all first-time employees who are working on this, let's say this as an example, this call center, all the employees who are getting trained on this, either they are getting trained on the call center tool, or they are getting trained on the call center in terms of their language, etc., etc. They are incurring all the training expenses. Second is all my new employees who keep joining, for them also entity B is willing to reimburse the training charges. Entity A is unable to recharge costs associated with training replacement employees. So if I am not having a net new addition to employees, it's only replacement. For all those replaced employees, I can't keep it. You may incur, as in entity A may incur expenditure towards training, but entity B will say, I will not reimburse that money. Now, entity A employees take calls from entity B customers and provide them with the online assistance for electronic product purchase from entity B. If I take a theoretical example, let's say this is entity B is Sony and has all the electronic products. Entity A Private Limited is a Indian company which is doing call center services for Sony. In that case, how should entity A account for these training costs? That's a question on hand. Whether the training cost incurred by entity A can be recognized as an asset for the training cost incurred to fulfill a contract with customer with entity B. While the fact pattern doesn't give you all those other additional information, let's assume that that all these training costs which I'm incurring, this contract itself with Sony is for a period of 3 years. So the larger question arises, hey, I am the CFO of this company entity A. I have incurred a significant training cost and sending these people to outside training agencies. All these guys will deliver the service on this contract. Contract period is for 3 years. Can I take this training cost which I've incurred on all my employees and prorate it for 3 years because my contract is for 3 years? Any thoughts? Anybody on the tool? Should be expensed off. Okay. Yashaswini believes that it is to be expensed off. Okay. Karthik and Yashaswini believe it is to be expensed off. They don't believe that by training employees you are creating an asset. Okay. So now let's see why we should either expense off or capitalize. Okay. So the reason for Yashaswini saying that because we are recharging back to the customer, I should be expensing off. That's the rationale for Yashaswini to say that this should be expensed off. Okay. Now let's look at what IFRIC, the interpretation committee, looked at before concluding whether it is the reason was there is a recharge. By that yardstick, Yashaswini, the training costs which I incur for replacement employees will never be recharged. So how did the interpretation committee evaluate this and conclude? Important for us to ascertain. So is it driven by me charging back to the customer, or is it driven by something else? Okay, let's see that. Para 95 of 115 states that if the cost incurred in fulfilling a contract with customer are not within the scope of another standard, entity shall recognize an asset from the cost incurred to fulfill a contract only if these costs meet all the following criteria. The cost relate directly to a contract or an anticipated contract that the entity can specifically identify. We can clearly say this training cost is for contract with entity B. The cost generate or enhance resources of the entity that will be used in satisfying performance obligation in the future. Absolutely yes. Without my employees being fully trained, they can't even deliver this contract. So item A is also met, B is also met. The costs are expected to be recovered. So Yashaswini, to your point, the asset accounting criteria says if you are meeting all these, I should be able to recognize this as an asset, and even though if I am recovering. Okay. Now let's notice whether because of all these criteria being met, how do I deal with this training cost? Under 115, there is no requirement of control for capitalization of cost. Okay. Unlike in days 16, where there is a control criteria, I don't have to worry about control criteria for capitalization of cost. Now, para 96 of 115 states that for costs incurred in fulfilling a contract with a customer that are within the scope of another standard, entities shall account for those costs in accordance with other standards. Let's say this meets the PP&D criteria or intangible asset criteria, then you will go and account in under that bucket. So if I take the 69B of 38, which is intangible asset, expenditure on training activity as an example for expenditure that an entity recognizes an expense when incurred. So now if I read this carefully, all of this put together, the important thing here is para 1538 says entity has insufficient control over the employees, hence future economic benefits cannot be expected. This is an important thing to notice here, because though you have trained the employees, you cannot have a lock-in. They can leave at any point in time, because of which you cannot say that I will amortize this training cost over the contract life. Because of though it meets all these criteria, because you are not able to still control those employees and their life within the company, you have no other choice but to expenses off under the standard of Ind AS 38. Okay, I'll proceed further. I will probably skip the borrowing cost and pick another example. Okay, let's take this mining example and let's discuss this. I don't know if any of you who are part of the audience have dealt with any example of mining company. So let's take this practical life example and deal with it. I will skip. It's a very busy slide, but I'll skip this and go to an example. Okay. Let's read this carefully before I jump into the example. In December, this is a very old one. Variable consideration includes changes due to future changes. Example, future performance or return of goods. ISB agreed with the staff analysis and conclusion that variability arising solely from changes in the market price would not be subject to variable consideration constraint in IFRS 15. Should not be impacted by passage of time. The analysis here, I'll take the example and explain this in a better way. The entity's entitlement to consideration becomes unconditional as understood by IFRS 15 on delivery of the date. There is also an IFRS 19 impact. So if I take this example, so if you look at mining companies, okay, the example is very relevant. So mining companies have contracts which says that while I enter into a pricing contract with the company based on the London Metal Stock Exchange changes, okay, I may modify the pricing, okay. So there are a lot of mining companies which enter into a pricing contract which also has variability linked to commodity exchanges. Okay. So because of which question arises, how do I account revenue on day one? When I'm billing to a customer, there is a variability involved because I am doing, let's say, an average pricing based on the last 3 months commodity index, which may not have been published at the time I am raising an invoice. So how does the accounting happen? So let's take this example. So in this example, if there are provisional pricing in mining companies, so there is an issue in terms of how the mining contract will be dealt with. So to the extent there are forward spot accounting to be dealt with, sorry, there is a revenue recognition adjustments in relation to IFRS 9. Very nuanced approach. I may not be able to deal with the detailed example here. So that particular adjustments, because it is linked to a future spot adjustment, that also needs to be adjusted. It cannot be taken out of revenue because the interpretation committee concluded that you have to deal with, and that variability is not a variability under IFRS 15. So this adjustments because of forward spot rate adjustments, which are part of the mining contract, and it could be in the contracts of other companies as well. Mining is very common. So that also is an adjustment to revenue. So in this example, not only the primary contract revenue which was coming through your purchase order, the future adjustment because of, let's say, this stock exchange or commodity exchange rates adjustment, that also has to be adjusted as per IFRS 9, and an impact has to be given on your top line. It could be both a positive or a negative impact. It's not necessarily a positive impact alone. So you have to give the impact on your P&L. Now, does anybody know what a breakage is? Have you heard about this term breakage? Okay, so let me move forward and explain this so that it becomes easier. all of you may be aware. I mean, all of us went and gave. In the past, it used to be Talwarkars. Now it is all cult fit, right? All of us make our New Year resolution saying that we want to be extremely fit. Then we go and join a cult fit, which says, "Hey, cult fit." Cult fit says, "Hey, Mr. X, you've come. Great. If you give me a full year fees, I will give you a huge discount." So all of us get lured into that. Then we say, yes, I want to pay a full year fee, because of which I will get a huge discount. So I end up paying the full year membership fee of this particular agency. Let's say Cult Fit or any other example for that matter. Customer may make non-refundable payments for the right to receive future goods or services. In this example of Cult Fit, I have given a non-refundable amount for future services, which is to use the Cult Fit facility for the next 1 year. Customers ultimately leaving the right to receive unexercised are referred to as breakage. Okay. So as I mentioned, many of us take those resolutions. We may not end up turning into Cult Fit after a couple of months. Either we are too busy or we have other priorities, because of which we are not able to go back and complete do our exercise there. So this is your classic breakage. This example is for Cult Fit. You could have taken your club membership. You could have taken any other membership of that nature, because of which eventually, if you are not able to exercise all your rights, there is breakage. Now, breakage causes consideration to be variable. So in this case, how should, let's say as an example, in this example which I'm taking, how should Cult Fit be accounting for this revenue? Should I account for revenue on day one because it is non-refundable? Should I account this throughout the period of 12 months? If it is non-refundable, why should I even bother about whether the person uses or not? Because I don't have to refund that money. Why should I not account on day one? So what IFRS 15 or Ind AS 115 says, and this is one of the reasons why a recent example, there was significant revenue reversal. In this example, it said breakage of if this entity expects the entitlement to be over a period of time, it says revenue recognized as a portion to pattern of rights exercised. Okay, and I'll give you some examples so that we can deal with it. Entity expects not to be entitled to a breakage amount, then it becomes only when the entire exercise of right becomes extremely remote, you can start accounting for the breakage also. So let's take an example and see how this is dealt with. So let's look at this example. Please call me company sells a prepaid data bundling entitling the customer to mobile data services up to 3 GB for 600 rupees. Any unused balance expires after 3 months. This 3 GB cannot be carried over beyond 3 months. Past history shows on an average 2.5 GB will be utilized by the end of 3 months. So that means the breakage is about 500 MB or 0.5 GB. Mr. M, this is one example, one customer. So if I notice there is a 3 GB data, fact pattern should be that normally one person uses 1 GB every month. So there is a 3-month proportionate allocation. But it is also a historical evidence that if I take this 3 months, most of my customers are only using 2.5 GB. So that means roughly about 0.8 GB per month is what the fact pattern in terms of usage. But I have one customer who's using 2 GB of the prepaid data at the end of month 1 itself. Because I have not put any restriction. I'm not saying to any customer that you have a 3 GB, but in a month you cannot exceed 1 GB. I have not put that. So it can so happen that a particular customer may end up utilizing the full 3 GB in the first month itself. In this example, Mr. M is utilizing the 2 GB fully on end of first month. So how do you account for this entire, for the purpose of IFRS 15? How do you account Mr. M's revenue and how do you account the normal revenue? Any thoughts? Okay, so I will now go ahead and show you how the entire recognition happens. Breakage revenue recognized in proportion to the pattern of rights exercised by customer. Okay, so if you notice our example, it was 2.5 GB. That means 0.5 GB is never utilized. Accordingly, I will start recognizing revenue of this 0.5 GB as it will never be utilized. So whenever the likelihood of they not utilizing comes into picture, at that time I will do this breakage revenue recognition. But in the context of this particular customer, Mr. Mohan, he has utilized the full in 1 month. So that means out of the 600 rupees in the first month, if I do 2 upon 2.5, because why 2.5 and not 3? Because my customer pattern of usage is 2.5 and not 3. So when I'm doing revenue recognition, I have to go with my breakage pattern, which is 2.5 GB. So 2 divided by 2.5 into 600, which is a prepaid card. So 480 rupees will be recognized as day one in the first month itself. So it's very important to note that I never put my denominator as 3, though my GB data utilization is available up to 3. So when I'm doing all these revenue recognition, I will go with my empirical evidence of how much my past pattern and how much has been my breakage. The balance will go recognized whenever there is a likelihood that they will not exercise the rights. And that may be determined at the end of second month or the beginning or the mid third month. I'm quite sure that they will not utilize. That's when I start posting the breakage revenue as well. Okay, now let me move on to another topic. So just to quickly summarize, what all did we cover till now? We spoke about revenue recognition in terms of when there is a breakage. We also spoke about bundle contract. We also spoke about sale of goods, and especially when we looked at the Incoterms. We spoke about situation where in a mining company, I have forward contracts, which is linked to my IFRS 9 accounting. How should revenue get recognized in those? So if you notice in each of these fact patterns, my fact patterns are different and my basis of revenue recognition also varies. Importantly, we also noticed in the example of training cost, whether some of those training costs or the cost to fulfill a contract, should I create an asset or a cost to fulfill a contract asset and start amortizing? In that example, because I did not have control of the employees, I was not allowed to do the accounting. Same was the case with that example of both the vessels construction and also the aircraft construction, because though I could own the design element, and in some cases in the aircraft example, I did not have the design element. Both example, it was concluded by the customer saying that there are no alternate use to this. Accordingly, they have not created a asset against that. They are doing the entire revenue recognition over a period of time. We also noticed that in the example of vessels, they could neither do an output-based accounting nor a unit of delivery-based accounting. They had to go down the path of doing the accounting based on inputs. So this in summary is what we have covered till now. I know we have spoken for last 1 hour. I just want to quickly summarize so that everybody is able to carry this through when they go back. Now let's go to the next example of loyalty program. All of us are pretty familiar with the loyalty program. Each of us who have our credit cards, we know that each of the credit card provider gives you a loyalty program. Now there are tons of loyalty program, be it your cred, be it your other loyalty programs. All of them have a lot of partnerships, right? If you take your HDFC credit card or your ICAI credit card, they have a link to Amazon, they have a link to Flipkart, they have a link to hotels, ITC hotels, all of them, a variety of linkages, right? Now, if I take an example, I'll say let's say this retailer A, okay? For theoretical example, let's say this is Chroma as a retailer, offers customer loyalty program in partnership with hotel, okay? Because Tata has both Chroma as a retailer, also has let's say their own Tata hotels, Taj hotels. So let's assume that this is linked there, so it makes it easier for us to resonate. So I am going and buying something in Chroma, which is giving me some reward points. That reward points I can go in and utilize in a Taj hotel. Okay, so that's the example here. Now customer can get 1 reward point for every rupee spent. Okay, this is 1:1 kind of matching, which is good. In many cases, for 5,000 rupees, you get 50 reward points because of the basis in which they are awarding the reward points. It also depends on the profile of the customer. If you are a gold customer or a platinum customer, your reward points also can go up. Now, the third thing is customers can redeem these points for accommodation with the hotel or discount on future purchases with the retailer. So there are 2 modes of redemption. One is with the hotel itself, or if you want to purchase further items within this retailer, you can leverage that reward points. The transaction price allocated to each reward points based on relative estimated standalone selling price basis is INR 0.001. So now let's look at, this is all the fact pattern we have got. Every rupee spent, I get 1 reward point. That reward point allows me to go and spend either in the hotel or to buy further goods. Based on the history, based on the evidence which the company has gathered, each reward point is worth 0.001 rupees. Now let's look at an example where in Chroma, and this is, let's say, the accounting in the books of Chroma is what we're talking. A sale goods worth 1 million is being sold by retailer A. Now, accordingly, 10,000 is allocated to a point. How 10,000? 1 million will give them 1 million points. Each point is equal to 0.001 rupees. So the value associated with that reward loyalty point is 10,000 rupees. Now the question arises, how should Chroma do the accounting? The retailer concludes that it has not satisfied its performance obligation, as it should stand ready to transfer goods or services if the customer decides not to redeem the points with the hotel, right? If it goes to a hotel, then it's a different thing. The customer may come back and say, I want to buy some more goods within Chroma itself. So how should in this example, Chroma do the accounting? Any thoughts? Okay, so let me move forward and show you. So if you notice here, transaction price of 10,000 allocated to points will be deferred and will be recognized when customer redeems the point with the retailer, or obligation is transferred to the hotel, or when the points expire. Okay, there are three conditions attached to accounting for this 10,000. The retailer need to access whether it is principal or agent in the arrangement if the customer elects to redeem the points with the hotel. In this example, what did we conclude? So against that 1 million rupees, 10,000 has to be deferred. And this deferred revenue of 10,000 will have to be accounted for when the customer comes back and redeems the point in Chroma, or if he decides to go and stay in a hotel, then I will transfer the 10,000 to hotel. It will no longer be my revenue. Or at the end of, let's say, 1 year, Chroma gives you an option to either utilize, or at the end of first year it expires. Then at the end of first year, you will start accounting the revenue. So I'll take a pause there. This was all I had in terms of revenue recognition, some of the practical issues. As I mentioned, this was in summary, variety of topics, whether it was sale of goods, sale of services, construction contract in the context of one of the customers, which I took an example, specified assets construction, which is made to order, and loyalty program breakages, variety of examples from different industries. The reason I pulled all of this together is I don't know the participants list who are coming here. They could come from diverse backgrounds. Each of these, because it is taking examples from different industries, gives you a flavor that an IFRS 15 Ind AS 115 revenue recognition will not be straightforward, simple AS 9/IAS 18 kind of accounting. You have to go into the contract and really read the contract, determine if the past practice of doing revenue recognition is right, and accordingly make the modification. It is no longer sufficient to say that whether I do revenue recognition net or I show those amounts as an expenditure, it is sufficient because there is no change in net profit. That will no longer be relevant. Please keep in mind, unlike Indian GAAP, which allows you to go back and do prior period accounting and not really make any changes, if you get any of these principles wrong, and if the auditor finds it out that these principles are wrong, whether it could be a recognition difference, it could be a measurement difference, it could even be a disclosure difference, without impacting profit and loss account or balance sheet, I may have made mistakes or errors in my disclosure. In all these three scenarios, IFRS 15 or Ind AS 115 says, hey user, hey company, you have to do a restatement. So if you get caught in any of these, and if they are material adjustments, you may have to do a restatement of your published financials. Okay, so that is the bigger risk you carry, because the moment you get into a restatement argument, you will have a third balance sheet. You will have to clearly explain what happened and why it happened and why you are pushing it back. So very important for all of you. We should not safely assume that all these things are very common parlance. It's very logical. Many of those things which you notice, and I keep saying this in all my IFRS training, which I've delivered both for corporates and internally as well, that one is to say that logically this is how I feel it. If you notice, there were a lot of interpretation committees. A lot of things became very intuitive to say, hey, this is very so common, this is known. But the actual answer could be quite different. So it's very important, and a word of caution to all of you is to go back and carefully read the contract. Only basis the contract evaluation, you should get to an answer. Otherwise, there is a risk that if there is an issue in terms of recognition, measurement, or disclosure, if you are caught on the wrong side and have a misstatement, you may have to create a restated balance sheet, which is not something your stakeholder management would like to see. I'll stop there, and I will now move to Ind AS 103. Any questions which you can take? Okay, I will stop sharing. So let me start with Ind AS 103. All of you are okay, right? It's just 1 hour 10 minutes since we started. I'm assuming that none of us are tired and we don't need a break. Sripad, Srinivas sir, is it okay that we continue?
Yeah, please.
We don't need.
Please.
Yeah. Okay. Perfect. So let me share my Ind AS 103 topic, and then we will talk through. Just allow me a moment. I'm hoping all of you are able to see my screen. Perfect. Thank you. So this is 103. Let me use my mouse pointer. It makes it easier. So what I will do over the next 1 hour 10 minutes, 1 hour 20 minutes is to, again, I'm hoping that we can make it very interactive. Before I do conversations on 103, are there any thoughts, any questions, any things which you are practically dealing with? Any of you want to share on 115 before I jump into 103? This will make it more interactive. Otherwise, it appears to me that I'm almost like a newsreader reading out something. Anybody in the participants would want to share any thoughts in terms of what they've dealt with? No, all of them are extremely silent. Okay. So I'll assume this as a no, Sripad.
Sir, there was a query actually.
Okay.
Whether it was, sir.
I missed any query.
From Naresh, I have two queries, the outbound freight related one, sir.
Sorry, what was the query?
The question goes like this. I have two queries. The question A, the outbound freight on domestic sales transaction incurred on sales should technically be a variable consideration item, hence reducing revenue. Kindly let me know if this is correct or it a multiple deliverable contract.
Yeah. So if I understand I'm trying to interpret the question. So I will assume certain things and try responding. What the queryist is asking is, if I have a sales order, and in that sales order I have sale of goods, which is there is a separate value, and there is a freight, outbound freight. Okay. Question. I think the queryist is asking a thing saying that this outbound freight, should I be reducing from my revenue? Okay. Or should I? What should I do with this outbound freight?
Correct.
Step one of this entire evaluation is whether this freight, and this was one of the example which was highlighted there. In the example of freight contract, are you a principal or are you an agent? Okay, that's the first question to answer. If you are just a agent, that means you are shipping the goods through some third party, let's say freight provider, and he takes the full ownership of any freight damages, etc., risk, etc., then you are only a agent for that particular freight. So even though you are collecting the freight from your customer, you will have to do a net accounting because it's an agent. You may be charging 100, you may be paying 80 rupees to your freight vendor. So 20 rupees is your income. So accordingly, you will only show 20 in your books. Let's take another example where you have your own freight services because you have your own lorries, etc., which you are able to deliver, and you take the full ownership. Then the question arises: should I split the goods separately and freight separately as two performance obligation? And basis that I should record this, or if my total obligation is to deliver the goods to the customer at his door, then the entire thing is the one performance obligation, and freight is a part of the same performance obligation. So then you can do a gross accounting of the total. Your incurrence of freight and all will be on your own cost and it need not be netted off the revenue. That is how the outbound freight accounting can happen.
Okay. Sir, there
Okay.
is a second question from Naresh V, which goes like this.
Okay.
Sale of a byproduct with a clear understanding as to purchase of finished goods at a later date. Example, brass borings being sold to the same entity from which we would be purchasing brass rod out of the borings so sold before should be treated as a sale with repurchase as opposed to an outright sale. Kindly confirm if the understanding is okay.
The way I see the example, okay, and if I take similar examples of similar nature, it appears to me that let's take this example that I am the original equipment manufacturer. This is a very common practice in the automotive industry. There's also in some other industries as well, but I'm taking automotive as an example. If I am Toyota and I am giving certain materials to one of my sub-supplier or suppliers, certain materials for them to complete a job work, and then they will do a value add and send it back to me. So what is happening is I am selling in the example which I think the query is asking. Hey, I am transferring the goods or transferring control. That is the way it is being articulated. I am transferring the goods or control to my job worker, toll manufacturer, bottler, contract manufacturer, by whatever name called. They will do value addition and send it back to me. So I do sale, repurchase. That's a question which is coming out, right? Is that a fair that brass is being sold to somebody?
Yes.
That brass is getting converted to something else and the brass is coming back. The question is, we are selling. So the first is sale of brass metal to that person. That brass metal is converted. The entire do that conversion. Sorry, Shripad.
No, I think there was some disturbance.
Okay. Sorry about that. From my side?
I guess so, sir.
Okay. Is it better now?
Yeah, it's absolutely good.
Okay. So in this example, which I was just telling you, contract manufacturer, I as a original equipment manufacturer or the main manufacturer, I actually fund certain tools, jigs, dies, machinery of my contract manufacturer. So I give those assets. So these assets, this funding is called customer asset funding. So my contract manufacturer will use the assets on my behalf. Assets will be sitting in the premises of my contract manufacturer, but assets will be capitalized in my books. That is step one. That is the most common thing. Second thing is, because whatever I'm transferring, from a GST point of view, I may show this as a transfer of goods, okay? But from an accounting point of view, he will act like my agent. He will only do value addition. So he gets paid only for value addition and not for It's not like a sale and repurchase kind of agreement. So it's very important to notice. Otherwise, what will happen if I am company A and Naresh is company B? I will do one sale account. Then again, that item which I have purchased will go into my, let's say, some main equipment. I'll again sell. So this item will appear as double counting in my top line. So I will get questioned whether the first sale was really a sale or was it more a job working transfer, because of which only the additional value which the job worker added, it came back and got added to my goods. So in essence, what I'm trying to highlight is a raw material which was brass which got transferred came back to me either as an FG or as a WIP, which will go into my main product, and accordingly there is only value addition to that contract. So there is no sale and repurchase. So it's a job work accounting. So you'll have to be careful to determine whether when you sold, would you lose the control over those assets or goods inventory, and the principal accounting. Okay, so Sripath, can we move? Are there any other questions before I move forward?
No, sir. I think that's it.
Okay, so let me now focus on mergers and acquisition, another important topic. Again, as I said, Ind AS 103, this has created a lot of practical difficulties and practical challenges. A lot of us get confused between asset purchase versus business purchase. There is also a newer definition of what is business. I'll walk you through that definition, important, because Ind AS 103 got modified, because IFRS 3 also got modified. And more importantly, because of this, what assets will come on to balance sheet also becomes extremely important. So all those various practical consideration I have tried to capture here. So let's focus on that and walk you through it. Now, all of us know this implementation. So entire Ind AS, it's very dated. All of you will say, hey, this Darshan, this is known, right? Anything, any listed company will have to follow Ind AS. Any company which with about 250 crore net worth will have to follow Ind AS. This is done and dusted. We don't need to worry about it, right? This is all known to all of us. This is like 4 years back story. Now let's take some practical example and see, in the context of mergers, demergers, how this thing can have an impact. Let's take this example, and I want you guys to, all of you to kindly see if you can kindly respond. A company net worth is 500 crore, is falling under Ind AS regime. B company net worth is 250, not falling under Ind AS regime. It is proposed to consolidate A and B. Okay. Option 1, B company merges into company A. Okay. And creates an overseas holding company. Clear? Ind AS applicable for, so the question is, Ind AS in this case, when is Ind AS applicable and to whom? Because B is merging into A, and A is also A is already having a 500 crore net worth. It is B also will get covered under Ind AS because A is getting covered, and accordingly you will have to apply Ind AS for B as well. If I take option 2, okay, where I am merging A to B, okay, very important. A already had Ind AS applicability. B never had Ind AS applicability because its net worth was below 250 crore. So the question arises, when will B start applying Ind AS? Any response? No? Okay, so let me. Ind AS is applicable from immediate next financial year, from the year in which the merger is taken. Why? Because the moment it starts merging, the net worth obviously of B has now significantly gone up. As per the Ind AS framework, you will apply the entire Ind AS 1 year after the subsequently after you meet the thresholds. Sripath, allow me a moment. I understand that maybe because there is there is all these Dasara celebration happening in the apartment. There may be some background noise. Is there a lot of background noise from my side?
No, sir, it's clear.
It's clear, right? Okay. So there is adequate noise cancellation. So there is no issue. Okay.
Yes.
Okay. So let me move. So in option 1, Ind AS anyway was applicable to A, B merging into A, B will start following Ind AS immediately. But in the case of option 2, very important, A is merging into B and B never had Ind AS applicability. So B will start doing Ind AS 1 year after the merger, because in the year of merger, it has already crossed the threshold, and after that merger, it will start doing the Ind AS. Now, if you notice the fact pattern here, Exco is a listed company and also a net worth of over 500 crores. It's falling under Ind AS regime. Why is a company below 250 crore not falling? Proposed to consolidate X and Y company. Okay. How do you consolidate? X company obtains control of Y company through 100%. We are not merging anything. Okay. The fact pattern was different. In the previous fact pattern, I was merging A to B or B to A. In this fact pattern, I'm not merging anything. I am saying X will go and buy the share from the promoters of Y company. I'll buy all the shareholding and take the control of Y company. X company obtains control of Y company through 100% stake acquisition in financial year 18-19. Because after this, what happens is Y is now becoming my subsidiary like this, right? This is the post facto acquisition accounting. So in this case, Y needs to prepare standalone Ind AS financial statements for the year ending March 19 itself, right? Because now it is a subsidiary. It has to follow the parent accounting policy. See the difference. Because of the moment I become a subsidiary, for consolidation purposes, Y also has to adopt the Ind AS and has to give the entire data to X. Otherwise, X cannot do a consol financials. So for in the year of 18-19 itself, the YCO has to prepare its standalone under Ind AS and give the same standalone to for Exco for it to consolidate. So this is different from what we saw versus A to B. So I'll skip this example. This is all about applicability. Let's take slightly more difficult ones now. Okay. Before we get into the difficulty in terms of Ind AS 103, I want everybody to notice that there is a significant change in definition of business. Apologies for this. All of us knew what is business in the past, input-output process. Some of those things have changed subsequent to modification of Ind AS 1 IFRS 3 definition. Now, what is the amendment which has happened? And if you have not noticed, it is important for you to notice here. What was the need for whether or not acquired set of activities and asset is a business is a key consideration in determining whether the transaction should be accounted for. A lot of people had a lot of confusion whether it is really a business or am I acquiring assets? Because if it is asset acquisition, it goes into Ind AS or IAS 16 and not comes under IFRS 3. So similarly, it was very important to ascertain whether it is really business acquisition or asset acquisition. Many stakeholders had concerns about how to interpret and apply the definition of a business. To address those concerns, the board set out to clarify the definition of business with the objective of helping entities to determine a combination of asset acquisition versus business. Minimum requirements to be a business: input, substantive process, together significantly contribute the ability to create output. That is, input process applied to those inputs must have the ability to contribute creation of outputs rather than the ability to create outputs. Okay, ability to contribute the creation of outputs, not necessarily output alone. There were a lot of some of them are nuanced example. It's not necessarily even if I'm not able to create an output, but I'm in the process of creating an output. Okay, it is still a business acquisition, because if I'm acquiring a company in an early stage, a lot of conclusion happened saying that, hey, the company is not even producing outputs. Should this be a business acquisition or asset acquisition? Conclusion was, this is where they modified the definition to say ability to contribute to creation of input and not necessarily to create an input. Okay, contribution to create an output was important and not necessarily only output. Market participants' ability to replace missing elements. Assessment based on what has been acquired in its current state and condition, rather than on whether market participants are capable of replacing any missing elements as per previous requirement. There's a flow chart. It will probably make it easier for all of you to understand. Let's pick this. Okay. I will skip this and take you to the flow chart. Amendment of definition to business. This is a flow chart thing which will help you to ascertain whether whatever we are acquiring is a business or not. So first thing is you will apply the concentration test. Okay. Fair value. If there is concentration, answer is no. Then you go into input and substantive process acquired. If you believe there is a concentration test, and that is there in the previous definition, fair value of the gross assets concentrated in a single or similar assets. If the answer is yes, then you go into asset acquisition. If the answer is no, you come down to input and substantive process acquired. Here also, it's a very iterative process which will take you to asset acquisition or take you to business combination. What is that we have to evaluate? Workforce to perform critical process, and it's not there is workforce to perform the critical process and other inputs convertible into outputs. Is the answer yes? Then it is a business combination. This input and substantive process acquired set activities, assets contain outputs. Answer is yes. You further go and say workforce to perform critical or process unique, scarce or hard to replace. Answer is yes, business combination. In this case, again, if you say no, it goes to asset acquisition. So this complex flow chart was created because there were a lot of early stage acquisitions also of a lot of companies, a lot of new companies. And there was a lot of confusion whether this should come under business combination or they should come under asset acquisition. So this revised definition of 103 or IFRS 3 gave a lot more clarity to establish whether you should go under the path of IAS 16 or come within the bucket of Ind AS 103. So let's take some practical life example. Under merger example, under demerger, under common control, let's look at some of those so that it helps you solve some of the nuances in the entire 103 accounting. NCLT I will skip because this is more in terms of the applicable date. Let's look at some real life practical example. Okay. We spoke about what is business combination, so I will not spend time here. Very common thing in terms of what most of us end up dealing with is common control transaction. As you know, the original IFRS 3 does not have guidance for common control. The guidance for common control is excluded from IFRS 3 because the interpretation committee chose not to put that guidance within the IFRS 3. But when it comes to Ind AS 103, there's an appendix added by our regulators, our standard setters. They said we want to give guidance for common control because there is a significant common control transaction happening in the country, and we want to make sure that it is not left open-ended. So they put that appendix C and said common control transactions are also covered in the IFRS 3. But the global standard does not have common control as a thing covered within the standard itself. So what is common control? Common control is where the transactions are having within the same parent entity, same individual, same group of individuals or entities acting in concert. Okay, and we'll pick this example so that you know. So, and importantly, control should not be transitory. It is not held for a temporary purposes, and accordingly, only then I can go down the path and say it is a common control transaction. So let's take some examples so that it becomes easier. Sorry. Okay. Now let's take this example, and I want you to look at it and kindly help me respond. Okay. A company is holding B and C. Okay. Now there is within B, I have business division X and Y. Okay. Now, because I want to do a reorganization of my company, I am shifting business. Okay. This is business BTA. All of us do know this, right? A lot of us who are tax practitioners call this as BTA, slump sale, right? B is doing a slump sale of business X from B to C. Okay. So in our context, we also call it as demerger of business X to C. So is this common control or not common control? Slam dunk answer. This is a transaction under common control. So because of this demerger, we cannot create any goodwill or any other type of asset. It has to be under the pooling of interest method. You cannot create new assets. Okay. That's the common control. Now let's take a similar example and see how we can do this differently. I'm hoping that you guys are able to see. Otherwise, I'll resize my screen. Yeah.
It's visible, sir.
Visible, right? Okay. Okay, I can't reduce this. So in this example, if you notice, there is company A, which is holding company B. There is a company C, which I'm doing a reorganization and demerging my business X, which is part of B, into another company C. Okay. Now, if you notice, company C is not part of my entire group. Okay, it is part of an outside group, and accordingly, this does not fall into the entire common control bucket. So here you can do purchase price allocation method. Very simple example, and I will make it more and more complicated as we move forward. Okay. Okay, let me. Is this disturbing? Is it in the middle of the screen? I will push this up. Okay. Now let's take this example. Slightly more complicated, so you need to spend a minute here looking at this because there are a lot of fact patterns here. There is a promoter at a top co level. Okay, individual promoter who is holding a promoter company 1. Okay, he is also holding promoter company 2. This promoter company is holding promoter company 3 100%, but holding ACO, which is a company which has operations 20% of that operation. Through promoter company 3 is holding 10%. There is public shareholding of 55%. Okay, because it's a list co. Then through my individual promoter, through promoter company 2, I'm holding 15%. A lot of fact patterns, correct? Now, this ACO has a business A, which I'm shifting to NewCo, demerging and shifting it to NewCo. All of you are clear? ACO, a listed company, engaged in several businesses. Promoter group collectively holds 45%, right? Something coming from here, something coming from here, all through this process. Collective percentage is only 45 because there is public shareholding of 55. A company intends to demerge one of its business. A company forms a new wholly owned subsidiary NewCo company. It then demerges its business A to NewCo. Pursuant to demerger, NewCo to have a mirror shareholding of ACO and will no longer be under the control of ACO. Okay. Other relevant facts: individual X is the chairman of the board in promoter company 1, and ACO has casting vote. Okay. Trend at past AGMs: highest voting exercise is less than 80%, of which more than half is exercised by promoters. Lot of fact patterns. It's not easy to consume. I'm hoping that all of you are able to read and consume this. Any thoughts in terms of what I should do? So let me put out the question. So whatever I'm transferring, demerging business to NewCo, is it common control or not common control? I'm hoping that I will have some participants who will respond. Any of them? Okay. I'm not hearing any responses. So let Shripa, this thing is clear, right? It's a complicated structure, but this is a type of structures we end up seeing in many of the companies which we deal with, right? Simple structures are not, simple structures are always easy to answer. The previous examples which I gave out are simple structures. You can easily give out those answers. No rocket science. This is where complication arises. This is where our value addition comes in, right?
True, sir. True.
Yeah. So let's take this and really evaluate. If you notice here, it appears, hey, 55% is public shareholding. How can somebody control this, right? You are transferring. There is no public. If public is holding more than the promoter, then it is not in control of the promoter. So let's look at how this has to be evaluated, because a lot of fact patterns are inside this. So if you know, I have not put out the answer. There is a reason why I did that. If you notice here, there are fact patterns which says out of the 80%, highest voting is exercised is less than 80, which more than half is exercised by promoters, right? Second is chairman also has a casting vote. Okay. Now, in all these fact patterns, it appears though the entire promoter group is holding less than 50% of the ACO and eventually the NewCo, through the casting vote and through a process where they are collectively voting together in terms of formation, etc., it appears that the individual promoter X, who is up and over, is actually controlling the NewCo, and accordingly, this NewCo transaction also has to be considered as a common control. Otherwise, from a plain reading of all this, it appears, hey, this person through various channels is only holding 45, public is holding 55, so this can never be common control. But the additional fact pattern shows that the public will never come together and vote. They are only coming, only 80% of the voting is happening. More than 50% of this 80% is being voted by promoters. They also have a chairman casting vote. Because of all these fact patterns, it appears that this entire demerger process will have to be accounted under common control. Otherwise, we could have easily got to an answer. This is PPA accounting, and I could have done fair value. This is, and you can get to a wrong answer because you are looking at a plain vanilla control and not looking at de facto control. So very important. This is the fact inside and also various arrangements, whether written, oral, or any side arrangements. You have to bring all of them into fore, evaluate them in totality, and then get to a conclusion whether it is a common control or a non-common control. Okay. So let me go to the subsequent examples. Now, in the context of business combination, various questions are being asked. Okay. Now, that's where the complexity starts arising. Who is the acquirer? Okay. And I'll show you some examples where you'll get confused. Who is really the acquirer? Is it company A or company B? It becomes very confusing. What is acquisition date? What are the identifiable assets and liabilities? And the non-controlling consideration, non-controlling interest consideration transferred. Should I account this with goodwill or is there a bargain purchase? All of this can change the balance sheet itself after you do the entire business combination accounting. And I'm not limiting my conversation to common control. I am saying large business combination, how this should be dealt with. So let's take some example. Who's the acquirer? Okay. A company to incorporate a special purpose vehicle. Okay. Promoters is the target company. Okay. Now, step 2, special purpose vehicle to acquire 100% stake in target company. Okay, so there are two parallel chains which are happening, A company and promoters. So, so the special purpose vehicle is acquiring target company, and also special purpose vehicle to finance acquisition partly owns funds and borrowings. Okay, let's keep going. Merge special purpose vehicle with target company. See how the entire equity, the group structure is changing. A SPV promoters target. A is having this SPV below. B is having the target company. So now we are merging shares held by SPV in target company to be cancelled. Because what we are doing, we are collapsing the special purpose vehicle into target company. Okay. Target company to issue 20 shares of ₹10 to shareholders of SPV. Fair value of the share is 2000. Okay. Originally, when I acquired, SPV acquired this target company, it acquired for 6000 fair value. Okay. Now I am doing all this at 2000 rupees. Book value of this target company is 1500. Fair value is 5000. Target company is issuing the shares eventually to A company because A will be the ultimate parent. Okay. Now let's go further. So how should the accounting happen? And I'm just highlighting how the accounting is happening here. Step 1, I had capital in the SPV books 2000. In the target books, because I had SPV and target, my capital was 300, reserves, net assets was 15. If you remember here, there was 6000 fair value at which I acquired, right? SPV as an acquisition vehicle and paid cash, SPV considered as acquirer. SPV is the acquirer of the target company. So what is happening? Investment in target 6000 because that's the fair market value which we determined. Okay. Step 3 says the merger has been announced simultaneously with acquisition. There is no time gap between acquisition and merger, and both transaction entered is in contemplation with each other. Transaction considered as linked transaction. SPV continues to be acquirer. Here, if you notice, it appears as though SPV is not acquiring Target. Target is getting merged into SPV. So here, the conclusion was, we will assume that SPV continues to be the acquirer. SPV assets at book value, target company assets at fair value, share capital discourse of target company to be done. Complex example. Because there is paucity of time, I thought I will explain this to you. I can get into a lot of details, but there are many more examples. This is a very complicated example in terms of determining how should the entire accounting happen. Let's take appointed date versus effective date. Okay, let's look at some of these examples as well. Appointed date, date from which the assets and liabilities of demerged undertaking vest with the resulting company. Effective date, all of you are aware, right? We file a scheme of arrangement under section 232 of the Companies Act 2013. There is something called an appointed date. There's an effective date when the entire regulatory formalities, in the context of India, it is the NCLT who will approve it, and you will file the NCLT approval with the ROC, right? That's when the entire formalities of the merger or demerger will consummate. So there is an appointed date, there's an effective date. Under Indian GAAP, accounting of merger given effect from appointed date, okay, which is different as per scheme, because courts approve the scheme which are effective from an appointed date. But when it comes to Ind AS 103, you can't apply this principle. Accounting given effect from effective date, not appointed date, which is the date on which acquirer obtains control of the acquiree. Generally, it's the date on which acquiree legally transfers the consideration, acquires the assets, and assumes the liability of the acquiree. Very important. This is a gap difference between IGAP versus 103, because we should not assume the way we were doing Indian GAAP accounting when all of you moved to 103. There's an important change. All your accounting will happen from effective date and not a retrospective appointed date, because that court scheme accounting is not allowed under 103. So as you can see, appointed date as per court scheme is not recorded as an acquisition date. Okay, let's take this example. Company A has entered into a purchase agreement with Company B for acquisition of its business. Following is a sequence of events. Step 1, signing of purchase agreement on 2019. Purchase agreement filed with High Court on approval. Jan 2020, purchase agreements provides that the profit from July 1st, 2019 will belong to Company A. High Court approves the merger on 25th March 2020. What is the date of accounting for acquisition date? 1st July, 1st January, or 25th March? Why 1st January? Because I can start accounting for profit from 1st January. Sorry, the filing date with High Court is from 1st January. So should I go with 1st January, or because I have the ability to start controlling the profits of this company from 1st July, or when the High Court gives me the order, 25th March? What is the date? If you remember, under 103, you have to go with when all the formalities of merger acquisition has been completed. You cannot go with an appointed date. Accordingly, neither 1st July 2019, neither January 1st, 2020 is relevant. You have to go with the acquisition date of 25th March 2020 only. Okay. So let's take the third step, which is purchase price allocation. I'm hoping that all of you have seen a purchase price allocation report where a valuer will give you a PPA. And this is important because you will notice how the underneath value of the assets and liabilities undergo a change. And now that is very important whenever you are doing an acquisition accounting. Step 1, acquirer needs to fair value the business of acquiree. Okay, you cannot go with book value approach. You have to get a fair valuation done. So you may have to get an expert fair valuer to determine the value. and give you the fair valuation report, basis which you will be able to do an accounting. An important nuance guidance here is up until next 1 year after your acquisition, you may keep modifying your purchase price accounting and also modify your goodwill. That's allowed under both 103 and IFRS 3. So on the first day when you actually announce an acquisition and you may have given a purchase consideration, you may or may not have all the PPA. So you may create a PPA accounting based on some numbers which can get revised subsequently within 1 year. Acquirer needs to fair value the business of acquiry, allocate the fair value to each identifiable assets and liability. Any difference between consideration paid and fair value of the business is a goodwill or a bargain purchase. Okay. Now here, important to identify, necessary to identify intangibles not recognized by acquiry. So very important for all of you to understand that acquired company may not have any intangible assets on their books, because as you know, more often than not, internally created intangible assets where we don't, none of the companies, neither the auditors allow them to capitalize. But when it comes to an acquisition, there may be a lot of assets, intangible assets, which are not on the books of the acquiry, but through a valuation exercise, you will identify those assets and do the accounting. So because of that, it's important for you as a management and also along with your auditors to get a fair valuation done, and basis that fair valuation, identify not only the assets and liabilities which are sitting on the books, but also intangibles which are not in the financial statements, and only if it meets the Ind AS criteria, account for it, and only after accounting all the intangible assets which are not on the balance sheet, you will arrive at the goodwill or bargain purchase. There are other considerations of depreciation and MAT and taxes. I'm not getting into the tax element here, but you should keep this in mind as well, because if you're acquiring goodwill, as you know, goodwill is no longer a amortizable asset. But if you have a non-goodwill, it is an amortizable asset. So it's very important for you to determine. Otherwise, more often than not, I've seen that everything which is beyond the tangible asset goes into goodwill. Now, putting a lot of things into goodwill is actually a bigger risk. The reason I say this is, if you have more goodwill on your books, every reporting period, you have to assess if there is an impairment indicator for that goodwill. It's not necessary to carry out an impairment evaluation. You have to carry out whether there are indicators of impairment. If there are indicators for impairment, then you have to carry out a detailed goodwill impairment assessment, demonstrate to both your management board and also to auditor that the goodwill which you are carrying is not impaired. So it's in your own interest to keep the goodwill low, A, because it is a non-amortizable asset, B, more importantly, it will force you to start doing impairment assessment, which will become a every reporting period affair. Just give me one moment. So purchase price allocation, kindly notice here, important for all of you to realize, acquired entity will not only take fixed assets, there are potential intangibles also, which has to be accounted for. This is what I was highlighting, the intangible assets, which are not on the books of the acquired entity to be accounted for. What are the potential intangible assets which has to be accounted for? It could be marketing related. So I'm not focusing on the fixed assets or other balance sheet items. Focus here in this flowchart is all about potential intangibles which you may want to consider for all the acquisitions which your company is doing or which your client is doing. Marketing related intangibles are trademarks, service marks, corrective, certification, trade dress, newspaper, mastheads, internet domain names, non-competition agreement. All of these are marketing related intangible assets which can come and sit on your balance sheet. Customer list, production backlog, which is orders on hand, customer contracts, customer relationship. All of these are customer related intangible assets which you can evaluate for accounting. Patented technology, computer software, databases, trade secrets, all of them are technology related intangibles. Contract related, licensing, royalty agreements, advertising, lease agreements, all of these are contract related. Artistic related, plays, operas, ballets, books, magazines, pictures, photographs, all of these are other artistic related assets which your expert in terms of valuation can identify and place a value. After identifying all this, your purchase consideration minus identified assets, identified liabilities, and potential intangible will be the difference which will either go to goodwill or a bargain purchase. As I mentioned, goodwill is nothing but the difference between purchase consideration minus all identifiable assets and liabilities will result. A positive difference will result in a goodwill. A negative difference will result in a bargain purchase. Under Indian GAAP, it's you are amortizing the goodwill, and you also have to test it for impairment. But when it comes to Ind AS, concept of amortization doesn't exist. Very similar to what happened in the tax law. You have to constantly test it for impairment only. Okay, this is more to do with the grandfathering provision. If something was already existing, how you should continue both under the IGAP and Ind AS regime. Okay, let's take some other practical example. So this debt versus equity classification I'll skip because this has more IFRS 9 element into the conversation and DES of 103. So I'll skip this for now. I'll focus on more 103 kind of concepts. Okay. Let's take this demerger and let's see what is happening here. So a company, this is a similar example what we noticed in the beginning, has B and C, which is part of the group. B is getting demerged and shifted to C. Okay, the demerger. As you can imagine, this is common control, right? This example we already picked up. Book value is 100, but fair value of this business is 500. How should you do the accounting? B company and C company are sister subsidiaries or fellow subsidiaries, as we call it, controlled by A. B intends to demerge X into C. C issues shares worth 500 to shareholders of B. Okay, C is issuing 500 to shareholders of B. Face value of share issued is 150. Okay, because fair value is 500, we are also issuing shares worth 500. So how should I do the accounting? Let's see that. How the transaction will be accounted in the books of A and books of, in this case, books of B. Okay. In the book of A, the transaction has commercial substance. Okay. Book A is what? A is the parent co, right? Investment in B needs to be tested for impairment based on net worth because you are selling off the entity, right? So if there could be a potential impairment which will get triggered. Investment by in this another thing is I am getting investment into C, right? A is again getting additional investment into C worth 500. So this will be an additional entry which has to be posted, and it may have a nature of dividend distribution because it is recorded at fair value. This has to be passed. But when it comes to, obviously there are MAT implications because you are doing a fair value. So you may have, and this is all in the standalone financials or separate financials of the books of A. Now, if I take in the where there is no commercial substance, where we are saying, hey, there is no commercial substance, I do not want to pass these entries. More often than not, we may get into this kind of accounting. I will not do impairment and I'll also not do gain accounting. I will just transfer debit investment into company C and credit investment into company B and do the adjustment and not do any further accounting. But when it comes to company B, which is doing the sale, right? It is selling the business of one of the segments of B into C. It has to account for this transaction. So there is a demerger of business without any consideration can result in a dividend distribution to my parent. So then I have to do dividend distribution accounting. But in scenario 2, where I'm saying this 500 rupees fair value and 150 rupees is the share value, then I have to again do a similar fair value accounting. But eventually, because this is again accounted as a sale of shares, a sale of one business. So I have 500 rupees which I'm distributing to my parent. I am accounted for a 400 rupee gain, and I am also reducing 100 rupee net assets in my books. Okay, let's move to another situation in a real estate sector, and let's look at whether it is business combination, whether it is asset acquisition or a business combination. Okay, let's move ahead and see that. Company A acquires land and a vacant building from company B. No process, other assets, employees are acquired in the transaction. Okay, looks like a plain vanilla thing. Should the acquisition as a business? So if you remember, we discussed about newer definition of business, right? It had that flow chart. It said whether it is whether there are significant inputs or outputs, workforce, etc. All that you saw, the left and right had asset acquisition, the bottom had the entire business acquisition. So in this example, it's fairly appears to be a fairly straightforward answer. Why? Because I'm acquiring land and acquiring a vacant building. I am neither acquiring any employees, nor any leases, nor any contracts. None of the other things are getting acquired. So it appears that there is only the input of land and vacant building. Process and output is not there. So accordingly, my answer is this is not a business acquisition. This is an asset acquisition. Okay. But when it comes to scenario B, in this case, acquires an operating hotel employees, franchisee agreement, inventory, reservation system, and all the back office operations. In this example, you can see it is a business. Why? Because inputs, non-current assets, franchisee agreement, employees, all of them are acquired. Process also have acquired. Output, which is revenue from operating hotel, is also acquired. In this case, it is evident that you are acquiring a full-blown business. Please keep in mind, this may not be an operating hotel. It may be in the process of launching. Even then it is, if you are meeting all these criteria, you may get to an answer that it is a business acquisition and not really an asset acquisition. So what is important when you're ascertaining business combination? Very important. It may impact your goodwill capitalization. Okay. Intangible assets may increase because lot of intangible assets which was not sitting on the balance sheet of the acquiree, you will bring it on your balance sheet. That will become an impact. The property, plant, equipment may have either an increase or a decrease impact, because when you do a fair value, either the fair value can go up or come down. Similarly is with inventory. Normally in receivables and payables, as all of you know, we carry this at amortized cost, and more often than not, in a fair valuation exercise, you may not get to a different answer that we need to do any changes in the receivables or payable. But when it comes to liabilities, it may change, because if in a valuation exercise, I may end up adding certain liabilities, which the other party may have treated it as contingent, but based on my own evaluation, I may consider that this may be more probable than not, and accordingly, I may put a value against those liabilities. Accordingly, the acquired assets or assumed liabilities may either increase or decrease. All this will have an impact on your return on asset turnover, and also the profit and balance sheet. So some of these things have to be carefully thought through. This is important when you are considering a merger, or you are considering an acquisition. When your management asks you, give me an evaluation of how this merger will have an impact, or how this acquisition will have an impact on my balance sheet. Some of these considerations are important for all of you to notice, and because basis this, you will be able to give a assessment to your management that this particular acquisition is having a positive impact on my company, or could have a negative impact basis basis your purchase price allocation, which you will evaluate. So I'll stop there. I think there are various case studies I took you through. I was hoping that this will be more interactive, but considering this is more a web-based session, I think many of you were unable to fully participate. But I will take a pause there, see if there are questions which I can more answer, and then pick up any things which I have missed out. Shripad, Srinivas.
Yes, there are no additional questions at.
Okay. Any participants would want to participate and explain any of the real life case studies which they have dealt with? Okay. I see the entire participants have gone cold. Let me ask, any of these examples which I walked you through, Was it all relevant to all of you? Have you dealt with some of these examples? Because the whole idea was to make it more real life rather than theoretical. There are many theoretical examples available in the standard and educational materials. Obviously, many of those theoretical examples may or may not be very real life. All the examples which I've largely put out here, as I mentioned, I've anonymized, and some of these are real life case studies. Okay. I'm not getting any response from anybody. As a speaker, I even if it is a response, whether if it is a response saying that, hey, this was not even relevant, is a good response to me, because then I know somebody has not understood, or they have not really liked some of the examples. I may have to curate it differently. But believe me, people who are part of this, whenever they are presenting, no, they really love, as a teacher as well. I speak in many sessions. The best thing I like about doing this is when I get responses. And any speaker for that matter will always like those responses, even if it is a challenge. Okay. So Srinivas sir, I am assuming that all of them have understood. I will have to safely assume that way.
Either fully understood or totally not understood. Understood the core that they don't have any queries.
Hopefully that is the case. Hopefully that is the case, that they have fully understood. Because some of those queries were more lucid, and I wanted to make it very, from simple queries to complex structures is what I want to build in. So that is how I structured it, so that the initial set of questions do not scare them. The subsequent questions was building in more and more complexity. I know I have ended an hour early. I was actually, this is almost like a 80-page presentation, if you notice.
Okay.
And normally I spend about 2 minutes per slide. So I was hoping that the 80 pages would give me about 160 minutes, which would leave me 20 minutes of Q&A. And during that 160 minutes, I was also expecting some Q&A, which will take me to this 180 minutes. Okay, I am still seeing the participants being extremely silent.
Members, you can have any queries, please feel free to ask in chat box.
So I owe you a session directly in your in Bangalore, so that I can make them more excited.
Physical, yes, sir.
That's true.
We'll do it, sir, definitely. Whenever from Hyderabad you're traveling back to Mysore, please make it a point to come to Bangalore branch once, sir. We'll have a physical session.
Absolutely. It'll be my pleasure as well.
Sir.
Absolutely, it'll be my pleasure.
With your permission, can we conclude, sir?
I'm good, sir. I was hoping that if there are any questions, I'll pick up. Appears to be that there are no questions for now.
Okay, sir. I thank you, sir, Darshan sir. I thank you on behalf of Bangalore branch of ICA for your valuable time and effort sharing your knowledge. I really highly appreciate, because even with your very tight schedule, immediately after the 30th September, you are coming and addressing our members. Really, it shows your interest rather than our participant, how much you love to teach and you participate. I heard that how difficult in Big Fours, how much struggles will be there finalizing. Immediately after 30th, you are coming and addressing your members. Really great. I thank on behalf of Bangalore branch of ICA, sir. Thank you, sir.
Thank you very much for giving me this opportunity. It's always pleasure of mine to share my knowledge, because the more I share, the more I learn. And thank you very much for giving this opportunity. Really a pleasure talking to all of you.
I thank all the members, those who actively participated in this program. I wish you all a very happy Dasra, sir. Happy Dasara to you also, sir. Thank you.
Happy Dasara to all of you. Thank you very much. Thank you.
Thank you all. Thank you.
With your kind permission, I log out. Thank you.
Okay, thank you, sir.
Thank you, sir.